How's it going, everybody? Thank you for being here. My name's Antonio, and today I have John Cash on the barbecue. He's the new CEO of UR Energy, a uranium company that's already in production and also one that I personally own shares of. Mr. Cash owns shares of this company as well, so watch this video knowing that we are both as biased as they come. This is also going to be a conversation that's general and impersonal in nature and one that does not constitute any financial nor professional advice of any sorts. That all said, Mr. Cash, thank you for investing your time in me, sir.
Hey, Antonio, it's great to be on with you again. I know you and Jeff spoke some months ago, so it's good to catch back up, give you an update on what's going on.
Definitely. It's going to be an interesting one. And you're right. You're actually the relatively new CEO of the company. You're following in the footsteps of Jeff Klenda, he was an very interesting person. He was very politically involved in the whole nuclear uranium space in the US, just an industry veteran, really. And this might be a good first question, I guess, is that what makes you and the board think that you're the right man to follow in Mr. Klenda's footsteps?
Oh, fair question. I've been in the uranium space since 1994. Even when I was in college, I was working as a contract geologist for the likes of BHP and Rio Tinto, doing exploration for uranium and other commodities. So it's the only commodity I've ever worked, for better or for worse, but it sure has treated me and my family really well. But my degrees are in geology and geophysics from the University of Missouri at Rolla School of Mines. So come from a good background there, a good reputation at that school. And I've always enjoyed saying that I went to University of Missouri at Rolla. People recognize that name around the world in the mining industry. So that's a good place to get started. But I've worked for the likes, in the uranium industry, worked for the likes of Rio Algam and Cameco as well. Did a lot of regulatory affairs. Also did a number of years of production, running well fields and plants. And I've been with Ur Energy since 2007. So I know the Ur Energy story incredibly well. I permitted both the Lost Creek and Shirley Basin. And so I know both of those properties like the back of my hand. So it's definitely an exciting time to be jumping into this role and really looking forward to it.
That's right. And you've also, when I tried reaching out to Mr. Klenda back in the day, maybe about a year and a half, 2 years ago, you communicated with me. So although not many people knew that, you were already, with everything involved in everything. So that's and you've probably been asked all the questions around how it is to fill Mr. Klenda's shoes already. So let's not grow you too much about that. Let's instead talk about Ur Energy specifically. The first thing that I did want to talk about is the first thing that I saw when I opened up your website, and it says in sort of in big letters on there that that you're North America's premier uranium mining company. And I like marketing when it's done well and truthfully. But so for me to know that that is true, that your marketing is done truthfully, I have to ask what makes you think that you're the premier uranium mining company in North America, John?
Yeah. We don't say we're the largest. We stay away from making that claim because there's one other company that is certainly one other company that's got the ability to produce more than we do. We say premier because of our cost of production. We've been in production since August of 2013. And when we ramp up production, we get to that 700, 800,000 pounds per year rate. Our production cost, our C1 cash cost are very, very good, around $16 a pound. And if you throw in all mine site costs, we're looking at around $33 a pound. So we believe that's what makes us premier. And that's why we make that claim is we've got a reputation of being very low cost and a reliable producer. We've produced nearly 3 million pounds now from our Lost Creek facility, and we're excited to ramp it back up. And I think the utilities, they see us as the premier operator in the US because of that low cost production that we've demonstrated historically and reliability of production as well.
I don't want to sound like a cheerleader, but I remember the first time I spoke with Mr. Klenda and I asked him, what should I look for in a uranium company? And he told me, simply ask the team how much uranium they've produced in the past and how much they're currently producing in the future. Because truth is, not many have produced, not many of the existing enlisted companies have ever produced or been a part of a company that's produced a pound of uranium. And a majority of them are never going to produce a pound of uranium,
Yeah.
and definitely not within this cycle. So that's the thing that did catch my attention there. You're throwing out that number of $16 of your cash cost of producing uranium. That's not total the cost that you would have to make money on the pounds.
No,
But
no.
that number is a number that URG has sort of thrown around for a couple of years now, right? But things have changed severely in the last couple of months. I don't have to tell you that, but does that production cost that you're mentioning, how's that being influenced by inflation, by what we've seen in the recent past?
No, Antonio, you're spot on. The $16 is not the point at which we make a profit. And you can count. You say you can define profit in a lot of different ways. Is it based just on mine site, or is it company wide? There's lots of games that the accountants can play. If you want to look at our all-in profit margins, you need to look at where we would be our all-in cost for the mine site plus corporate overhead. We're in the 40s when we throw everything in the kitchen sink. So when I say C1 cash cost of $16 a pound, I mean operations cost. That's manpower, chemistry, electricity, things like that at the mine. And if you throw in additional cost, I mean, that's other cost, including replenishing pounds, going out and doing exploration and other taxes and things like that have to be thrown in, like put us in the 33s. So we did a tech report that we released in March of this year that counts our cost. And we included inflation up to that point that we knew was out there. We're drilling, we're working, we're operating. Right now, we're producing pounds. So we know what the actual costs are. So in that model that we put together, that's not a lot of speculation. Those are based on actual costs that we were seeing in March. Obviously, inflation continues, prices continue to go up. So it will have an impact on those numbers going forward. But if we can ramp up to the 800,000 pounds, a million pound a year run rate at Lost Creek, we still think that our all-in cash costs were in the mid 30s range even today. So we still believe we're going to be a very low cost producer. We've proved that in the past that we run a tight ship, and that's a testament to the quality of the asset that we're mining, but also it's a testament to the quality of people. Our people are miners. They've been miners their whole lives and for decades. And so they know how to run facilities. And I think that's why we're able to keep our cost as low as we are.
I'm happy that you're mentioning the fact that you're right now in production and the fact that you're hoping to ramp up to about that 1,000,000 pounds per year at Lost Creek, because the way I understand is that you're technically in production, but you're not producing all that much right now. Right. Not even enough to report on it, I guess, with the last report. But when do you hope to be in full production? Is it by the end of next year, by the end of 2025? What do you think?
Well, you may have read our press release that came out just a few weeks ago that we just signed up a long-term contract with a major U.S. utility. We have requirements that we can't discuss pricing and certain other things, but that contract is good for 200,000 pounds per year for 6 years. But we need more than that to be able to justify a ramp up. But we are working right now with utilities and discussions with them, trying to get additional contracts in place that would justify the ramp up. But if I got those contracts in place today, don't expect that, but if I got them in place today, just as an example, we believe we can be up to the 1,000,000 pound a year run rate within about 6 months. And, it's a challenging time for any business in the U.S. Because of inflation, but also because of manpower. And parts, supplies, chemistry, and all of that, getting that on hand. We implemented a program late last year where we told our engineering staff, if it's going to delay production by more than 6 months, go out and buy it now. Go ahead and get it in the queue, get it on the ground. And because of that, we think we're in a great place. We've got the equipment we need to be able to ramp up. That doesn't concern us. So we think we're in a good place there. In addition to that, because we've been in production in the past, we've got 13 header houses out there that are in limited production. And if we needed to rob parts from those to move forward, we have, years of parts available to us to be able to move forward. We don't anticipate needing to do that, but it is a plan B if we have to go to plan B. The other thing that is quite challenging out there, and I'm not afraid to admit that, is manpower. We've been able to make hires as we need to. We've hired a few people very recently, but it takes a lot more effort to make hires now than it did, say, 2 years ago, pre-COVID. So the people are out there. You can go and get them, but don't expect to get 50 resumes or 75 resumes if you post something on monster.com. It's not going to happen. You're going to get 2 or 3 or 4 resumes in, and then maybe they're qualified, maybe they're not. You may have to go out and look a little bit harder, but we've been able to find them, but it does take a lot more effort. And so we are experiencing that. And I think everybody in the US and maybe even globally is experiencing that issue right now.
Definitely. I can tell you that as a business owner myself, it's even happening over here across the pond. And you're bringing up very important points, is that you're going to have to do more than just turn up the volume to increase the capacity. I know you're licensed to go into production, but what else are you going to need to do before you can increase? Like, it's not, as I said, it's not just a matter of turning up the volume button, right? You need to do more work than that.
Hiring will be number one. So if we make a decision to go, that'll be number one, is hiring. Beyond that, we've been drilling for quite some time now to drill out header house 2-4 and to construct that. And that's very, very well advanced at this point. So we're getting to the point now where that could be ready to turn on within weeks. And then beyond that, we start drilling out header house 2-5 and produce there. We've also got a number of other header houses that we can turn back on and have production and flow. The head grades aren't where we would want them to be, but it could bring pounds into the plant for us to process. So we do have that capacity. So getting people hired, that's number one, and getting wells installed and header houses constructed, that's where we would go. But all of that can be done, and we're inching our way toward that slowly but steadily. That's intentional. We don't want to burn a bunch of capital right now, but as we get more daylight into production and we get more encouragement, we will ramp that up as the situation dictates.
I heard you mentioning capital, but you're not giving me any specific numbers. Do you know? Could you get more specific at how much more money you need to spend before you actually start making money?
Yeah. So to get up to £1 million a year run rate, we're looking at probably less than $15 million of capital outlay right now to get Lost Creek up and running. If things really got hot and we wanted to start up our Shirley Basin property, that would take about $30 million to build it out and get up the well field up to the £1 million a year run rate. So all in, we're looking at around $45 million to get both of those facilities, by the way, both of which are fully licensed and permitted, to get them up to each of them to £1 million a year run rate. So 2 million pounds per year. Right now, if you took a look at our Q2 report, we've got a little over 42 million in cash at the beginning of August. So we're in a good position to be able to go out and do that. And beyond that, we have some good inventory in place, a little over 300,000 pounds of inventory that we can sell into the spot market or to the U.S. government. We have made a bid to the U.S. government to sell that portion of that inventory. And so we could have some additional cash coming in from those places as well to be able to round out our needs. So very, very frequently I get asked, oh, when are you going to be back in the market? When are you going to sell equity? What can we expect? Well, first of all, we don't divulge that. But number two, we're in a good position. So I don't need to be in the market right now. Our staff, I've bragged about them, how tight-fisted they are and how careful they are with the capital. Yep. And so that 42 million, we can stretch that a long ways.
Yeah. Just, as a shareholder, I would prefer you not to do that, but I do understand where you're coming from. How do you think you're going to be dealing with, I'm just going to assume, I'm going to call it a win. I'm just going to assume that you're going to ramp that production up to that 2 million pounds. So when you ramp it up to that much of production, how do you think you'll be dealing with selling it though? I mean, I know you can't comment too much on potential contracts, nor the ones that you're in right now, but do you expect to contract those pounds more and more at a fixed price, or as the fundamentals in the uranium market improve, or do you expect to be willing to be more leveraged towards the spot price of uranium?
Yeah, we're not too interested in being leveraged to the spot price. It's too ephemeral. We don't rely on it. It's here today, gone tomorrow. If Sprott is buying, then the price goes up. If Sprott's not in the market, then it declines. So we don't want to be too subject to that. We really would prefer to be in long-term contracts with stable utilities, either in the U.S. or in Europe. And that's really where we're pursuing contracts to be able to fill our book up. So, we'd like to get at least a couple of more good contracts in place to be able to justify the ramp up. As far as the terms of those contracts, fixed price is really not what we would prefer. I'm not saying we wouldn't do that, but with inflation being what it is, I don't want that exposure. So if it's fixed, there's got to be some type of a kicker on top of that to recognize inflation. So that has got to be considered as part of any agreement. Otherwise, it's going to have to be at a higher price so I can take on that risk.
Of course. Why is that actually? That you cannot be fully, I don't know if you can or don't want to be fully transparent on the pricing and the interiors of those contracts, I guess. I mean, it's kind of curious to me now that I'm thinking about it as a shareholder to be invested in a company, in a sector for which I have no idea how much you sell your product for. Like if I were in Apple or something like that, I would literally know the exact price. So how come you don't share it?
Well, number one, the utilities typically won't let you share the price. So that's part of the agreement. The customer says you're not going to share the price. They don't want the world to know what they're contracting at. And number two, next time we approach a utility, we don't want to have set the price. We want to be able to negotiate that and be able to seek even a better price as market conditions change. So if we divulge that price, when we go to company B, they're going to say, hey, you signed a contract at this price. We know that's what you'll sign at. And that's we're not going to negotiate. So those two reasons. Number one, the NDAs won't allow it. And number two, we don't want to discuss it anyway. Ultimately, though, it will come out in the paperwork. Obviously, we can't hide that from our share owners. We need to disclose that and be transparent. And when we do our quarterly reports, when we're in production, that's going to become very apparent. I would say, though, that we're not going to be signing contracts that are not profitable. We're not going to break even. We've got a lot of shareholders that have been with us for a very long time, including myself. We want to make money. So we're not going to give the pounds away. We're going to sell them at a good profit, and we won't sign contracts otherwise.
I was going to say that it's true. Like you can find that in a paperwork, but it's also interesting to me that you don't include your P&L in your quarterly highlights. I mean, obviously it's on CDAR and you can, or on the SEC website, you can go fetch it. But how come you don't include it just in the headlines?
I'm sorry, P&L.
Yeah. Just like your results, your profits, the how much money you make.
Yeah, typically we do. It's there in the quarterly reports on a per share basis. It's in there. We may not always include it in the press release, but it's certainly included in the quarterly. It's something that our CFO always makes sure is included, and it's required that we announce those numbers.
Yeah, I mean, just like in the headline, like I have to go on to like the SEC website and actually fetch it. Like it was not immediately in the summary, I guess, of the news. Yeah. That's what I was wondering.
Yeah, and right now we're not making money because we're not selling into contracts. So historically, I think when we've been selling into contracts, when we've been profitable, we announce those numbers. But otherwise, they're in the report. It's not something we're bragging about at this point.
Right. Next quarter, though, or better said, this quarter, you you will have some profits, I'm assuming, because they will come from from the contract that you did with that one utility. And again, Odo, you cannot tell me who that is and all the other stuff that we just talked about. I did want to ask you about how those talks are going, I guess. Like, what can you tell me about the feeling, the vibe, if you want, at those meetings? Do you feel
well, first of all, let me go back to your comment, then I'll answer that. We don't have enough contracts yet to ramp up production. So until we ramp up production and start filling those contracts, we're not going to have profits, positive profits to be reporting. So I want to be clear on that. But as far as the tone and tenor of those discussions with the utilities, I think it's pretty clear. We're beginning to see a bifurcated market. I think utilities are very concerned about getting Russian supply. I think they're concerned about shipping out of Kazakhstan. That's become quite challenging. So it's becoming clear that I think not just US, but Western producers, including Canada and Australia, the utilities are increasingly interested in talking with those producers and signing up long-term contracts with those reliable producers. But utilities are frequently now expressing interest and saying, yeah, we're very interested in signing up deals with Western producers. And I think that tone has changed. A year ago, pre-invasion of Ukraine, utilities were relying on Russia and Kazakhstan, Uzbekistan, and other places to be able to get those pounds from. And I think they're beginning to recognize that that's tenuous. That can be cut off. And it's a risk that they are wanting to better manage, I guess, maybe as a way to put that. But yeah, we're beginning to see a bifurcated market. I in some respects, I wish that contracting was public. I wish there was a public market where everything was published and we knew exactly what was going on. But that's not the way the uranium industry works, unfortunately. So even if there is a bifurcated market, most people don't have any insight into it. And that's, I think, unfortunate.
Sure. I was thinking more about the pounds. Obviously, know that you're not in production, but I was thinking more about the pounds that you have ready for potentially the reserve or maybe for the spot market. But now you're also telling me that utility, well, I mean, guess what you're telling me? It makes me think that the utilities are potentially having issues finding pounds in the spot market. Do you think the spot market is drying up as it is?
Nothing more than a gut feeling, but yeah, I think the spot market is beginning to dry up a bit. I'm really anxious to see Sprott get back in, get positive on their valuations so they can go back onto their ATM and jump back in and see what pressure they put on the market. That's going to be very telling. But my sense is they're going to put some pressure on the price, and we're going to see it to start to climb again back to levels it was a few months ago, toward the beginning of the year. So I'm looking forward to that date. We'll see if I'm right.
But you don't plan on trying to look for pounds on the spot market, and because I know you've done that in the past, but you don't think you're going to be doing that anytime soon?
No, we don't think so. Again, we would much rather sell into long-term contracts. We don't want to gamble on the market, double down essentially as a miner, and we can produce pounds very cheaply. So no, that's not something we would prefer to do. Now, if contracts allow it in the future, and if the spot price goes down really, really low, would we go back into the spot market and buy pounds that qualify to be sold into the market? If we can do that and have a higher profit margin than from mining, yeah, we would consider that at that point. I mean, we owe that to our shareholders to be able to do that. But right now, that's not in the cards. We don't see that in the foreseeable future.
Right. I'm just thinking of that reserve that you have, because you're transparent about how much uranium you have, which I think is good. Yeah. What about the pounds then that the U.S. government is looking for? Do we know more details about that? Like how much, what are they looking to pay? Because I know you submitted an offer, but again, we don't know too much about that. What can you tell me about that?
Yeah. So the U.S. government is looking to purchase up to 1 million pounds per year, 1 million pounds total. Keep in mind, this is a one-time purchase. They're not looking to support the ramp up of any production. They are looking for pounds that are already in inventory, up to 1 million pounds. The total funding, it's a 1 year, one-time funding. It's $75 million. Early on, there was talk of much more funding than that, and over a 10-year period in excess of $1 billion. That's no longer on the table. I know some mining companies have put that out there maybe to try to get some excitement in the market, and I understand that, but that's not been a part of the serious discussion for a very long time. So we're looking at up to £1 million, one-time $75 million, one-time allocation. The money, that 75 million, it'll be split probably at least into 3 buckets, if you will. First of all, DOE is going to take their cut. They need to run the program. So they're going to take a little bit off the top to run the program. I don't think that'll be much, probably less than $1 million to run the program, maybe on the order of $500,000 to run the program. But also that money will also, some of it will go to Converdyne to do the conversion of those pounds. So there's going to be a cut there. And then the remainder will go to 1 or 2, maybe 3 mining companies. If I had to place a bet, I would say 2 mining companies, but maybe 3 mining companies. I think there have been 3 companies that have made announcements that they have made bids into the program. And so we'll see who prevails. And you can start doing some of the math and kind of backtracking it and making some assumptions of, the U.S. government, they get maybe $500,000 to run the program. Converdyne, maybe they get 20 million, 15, 20 million for conversion. What does that leave for the U.S. miners? And I don't think they're going to get to £1 million of purchasing. My sense is they may get to 700 or 800,000 pounds of purchasing, but we'll see. We'll see how far the money stretches, and we'll see how much goes to Converdyne as well.
There's not many companies that can profitably produce. I know you don't have to produce because you have it in stock, but there's not many companies that can profitably produce uranium between $50 and $60 in the US. If I remember correctly, Jeff Glennon told me that a while back, even before inflation was ramping up. So it's going to be a curious situation to see who they get those pounds from.
Yeah, it is. And, something that's interesting is, we're trying to determine pricing and look at our cost of the acquisition and things. And we held on to our pounds. And I think the other 2 companies held on to their pounds, even when the spot price got to 65. So I think that's instructive on the thought process of the U.S. mining companies on what they think the valuation is. So we'll see what, I don't know if we'll see what other companies bid. I suspect we will for the winners. The others we probably won't, but that'll be out there probably by the end of September. The validity on the submittal to the government was good through September. That was their date, not ours. They selected that, and they're saying that post validity, once they make the purchase and notifications, that the material has to be delivered to Converdyne within 60 days after that. So before the end of this year, this will all be said and done one way or another, and we'll all know.
Exactly. That's going to be interesting. They had a bunch of rules on there too. It has to be produced in the US and had to already be produced, because they're not trying to help you get into production.
Right.
And actually that makes me think of your projects and what you're going to be doing with them eventually, because they're not, the 2 projects that you have, they're not super large, right? So I'm just thinking, what's the plan after that? After you sign a couple of contracts for delivery, oftentimes those are long-term delivery contracts. Are you just going to be honoring those and producing, keeping your head down, or are you also going to be looking to replace those pounds through exploration or potentially maybe M&A? Yeah.
So yes and yes, but keep in mind, I should talk about our 2 projects. I'll start with Shirley Basin. Shirley Basin is completely drilled out, 8.8 million pounds of measured and indicated resource, very reasonable grades, but it's completely defined. I can't sit here and tell you we're going to go explore at Shirley Basin and find more pounds. I think that's fairly unlikely. It is drilled out on a very close spacing, so I don't think we grow that resource, but it is very well defined. I guess the plus side of that is we don't have to go drill. It's defined. We've got the data. I can go out there tomorrow and start putting in patterns. And in fact, we've already got them designed and ready to go. So there's no drilling cost associated with exploration or delineation. It's all done. On the other hand, Lost Creek, good resource in the ground, but there's a lot of extra potential out there. There are a lot of roll fronts that we've not explored them to their ends. We've got other properties out there, LC East, LC South, LC West, and LC North, all of which have mineralization on them, and a tremendous opportunity to grow the resource there. So our life expectancy at Lost Creek, yeah, you're right. It's not going to be a 40, 50, 60-year project as we know it right now. But I can tell you every single time we've gone out and done exploration at Lost Creek or in the surrounding properties, we've grown the resource, and we've grown it remarkably, typically for around 50 cents a pound. So this is a forward-looking statement, and so I'll caveat it that way. But we believe that our success in the past is an indication that we'll have success in the future and be able to continue to grow that resource substantially going forward. And beyond that, we've got other properties as well. Lost Soldier that we've got a technical report on that's out in the public. We've also got North Hadsel, Arrow, and other claims that we know have mineralization. So yeah, we don't have a lot of pounds in tech reports that we talk about and brag about, but we do have tremendous potential, and we've demonstrated that potential every time we've drilled.
Are you telling me that you're not out there looking for M&A, or?
We are.
Okay.
Yeah, we are. We would like to grow the company. I think that's important for our shareholders to be able to do that. My philosophy on most everything regarding your energy is very consistent with Jeff's philosophy. So really very little has changed there. We are out looking for opportunities. I've not been shy about that whatsoever. I think the world, the market knows that we're out looking. We've got a lot of lines in the water, but having said that, we're very conservative by nature. We're a mining company. We're not a marketing company. We don't do much marketing. If you saw our marketing budget, it's pretty paltry compared to a lot of other companies. But we're serious miners. And if we go out and make an acquisition, it will only be for assets that we believe we can put into production at a reasonable price. We're not going to just go pick up pounds so we can claim pounds in the ground. That's not a game we play. Never has been, and I don't think it ever will be. I think being a premium producer, I like to say we're a value company in our space. To be able to retain those two titles, we're going to be very careful with what we acquire. That doesn't mean we're not aggressive out there looking. It just means we're going to be very careful any deals that we consummate.
I was just going to say that it's probably not easy for you because you have a strict set of rules. Like, I assume you want to stay ISR. I assume you want it to be domestic in the US. So that all of a sudden, it screens a lot of companies out of the picture.
It does. M&A, it's an interesting beast. We get opportunities quite frequently. People come to us with propositions on small projects or big projects. And so whenever we see one, the first question we will ask ourselves is this really the mandate of the company? Is this really what our shareholders want us to do? And if we can't answer yes to that, then we'll politely decline. But if it looks reasonable, if it looks like there's a synergy to the company, it'll add value to the company, then we'll pursue it. But that adding synergy is a really important aspect. A lot of times I see other companies out there, they're just picking up one project after another, even going to other countries, countries that speak a different language, countries that have a different social license, different mining technologies, and they make acquisitions. And I scratch my head and I say, what value did that truly add? Because you still have to have completely different an executive team to manage that project, because you don't have the expertise. So you don't have the technical expertise, you don't have the legal, regulatory. So what did it add? So from our perspective, we're not afraid to go seek something that's foreign. Canada or Australia are prime targets for us because we understand the regulatory regimes. We speak the language. So there can be a synergy there. But for us to go to a country where there's not a good social license, we don't understand the regulatory oversight, or we don't understand the mining technique, that doesn't make sense. And we're not going to pursue that. But we'll put together a team if things look good. It looks like we got the mandate from the shareholders and it looks like there's a synergy. We'll put together a technical team, and that technical team, it runs the gamut from finance and legal all the way down to geology, economics. We'll run through all of that, and we'll do an exhaustive due diligence that can take many months to run through it. We're not going to just go out and buy something without really kicking the tires and understanding it. And so we'll look at things very, very carefully before we make a decision. We'll look at royalties. That's another thing, Antonio, that really shocks me. Very often we'll go out and do a due diligence, and things will look pretty good until you get to the royalties. I've seen royalties in our industry, 12% royalty. That's a project killer. And when I see that, typically the immediate response is thanks, but no thanks. Maybe there's an opportunity to renegotiate that royalty. And if so, then maybe we'll keep the door open and we'll explore it further. But a 12% royalty is just a real game changer, and it's a project killer. Yeah. And there are some of those out there that we run into. So yeah, a lot of issues like that. And social license is important. The U.S. typically is a pretty good place to mine. But even recently, we've seen some things in the news about projects where they simply don't have the social license. And if it's in an area where there's not going to be a good social license, probably we're going to back away. Why go through the mental abuse of trying to permit and operate a mine where people don't want you? And we're going to try to stick with good, friendly jurisdictions. So maybe I went too long there, Antonio, but yeah, M&A is important to us. And those are all things we look at, but we are very, very careful as far as any deals that we consummate. They have to maintain that premium for our company and that value.
It was a good answer. Definitely not too long. I appreciate the longer answers because you can go more in depth. But it sounds more to me like you're talking more about the A part of the M&A, the acquisition, and not so much about the merger. Although some of the remarks that you told me there, I was about to ask you about some of your peers that are into ISR US production, whether a potential merger might be there, but it seems to me like you're not really, you don't have the exact same strategy as most of your peers with ISR facilities have. So
yeah, we're not opposed to the M of M&A as well. But again, it gets back to the same issues. They've got to be a mining company. They've got to have good quality assets. And that's a very, very, very short list. One other comment I would make, going back to the acquisition, but it's relevant to mergers as well, is holding cost. There are opportunities in the U.S. and globally that we've not pursued because the holding cost and the liabilities are simply too great. The risk is too great. Companies have moved into areas, they've racked up immense liabilities. Their bonds are incredibly large, and we're not going to go there. We can't put our company at risk. If we were very confident that we were going to go in and sign very large, long-term, high-dollar contracts to produce uranium from any M&A activities, then you begin to appreciate and understand and can calculate what that risk is and get your hands wrapped around it and make a decision based on that. But that's not where we are. The market still isn't where it needs to be for most U.S. mines. So because of that, to take on that huge annual burden, that big burn rate, to hold on to those assets for no line of sight to productivity, it can be done, but there's tremendous risk associated with that. So we're very careful there to look at what the annual burn rate is to hold that asset for 2, 3, 4, 5, 6 years. Who knows at this point? I feel very strongly, personally, that the nuclear industry is a growth industry. And in the long run, it's going to be fantastic for your energy. But when you look 1 year out, it's tougher. I think we've got great opportunities to sell to the U.S. government, and I think we're going to be successful there. We are contracting, but I think that the real growth is coming. It's growing slowly, but I think it's going to pick up steam. You take a look at what happened recently with Congress and Biden passing the Inflation Reduction Act. And I don't mean to change gears here, but this is quite relevant. That is going to add tremendous help to the U.S. nuclear industry. It's going to keep reactors up and running. There was an assumption 2 years ago that some of the U.S. reactors would be shutting down as their licenses expired. And I don't think that's the case anymore. I think most, if not all, of the U.S. reactors are going to stay online. That's going to put additional demand for global production and U.S. production as well, to be able to keep them up and running. Other countries around the world, strong signals on nuclear. Japan, even Germany. For the longest time, Germany would not get off the position of shutting down the reactors, post Fukushima. But finally, it looks like they are beginning to seriously consider keeping at least some of their reactors up and running for the foreseeable future. No final decisions have been made there, but they're having a very serious discussion at this point. The build outs in China, India, England, just all around the world, we're seeing tremendous growth in the industry. So I think long term, I am a tremendous supporter of nuclear. I think the price is just going to continue to grow as that demand grows. And so I think we've got a really bright future. But getting back to where we started here, am I willing to go out, make an acquisition of an asset? And I'm going to make up a number here, Antonio. It's not based on any particular company, but am I going to pick up an asset that's going to cost me $10, $15 million a year just to maintain it, with no opportunity for production until the price gets to $70 or $80 a pound? I'm not willing to take on that risk. There are some other assets out there that are maybe available in the future that their cost is $50 a pound. Am I interested in acquiring those? Yeah. Now we're starting to get into the realm of it's reasonable. I'm taking on maybe some reasonable risk, especially if they have not encumbered themselves with a lot of environmental liability. So, in the M&A world, we have to consider all of those things. The quality of the asset. When can you put it into production? What's the holding cost? And so those are all the things that we're looking at routinely in the M&A world.
I thought that as a junior mining CEO, you would say something like, if it costs me $10 million to hold the assets, but I can raise $15 million every year and dilute the shareholders, I'm going to do it, because sometimes it feels like the industry just works that way. But I'm happy to hear the opposite. To your point about Germany and about nuclear being a growth industry, I absolutely agree. Germany actually, yesterday on the 16th of August, some government officials apparently wanted to stay anonymous, but they confirmed that Germany will postpone the closure of the last 3 remaining nuclear reactors that they have. So they're staying on, and that was big news. Or it was a Wall Street Journal exclusive, I think, that they spoke to. But it's something that it's happening. It's already here, and you see a lot of support, and I absolutely agree about it being a growth industry. I don't want to lose too much of your time, because I know you got to go in about 15 minutes, and I have a few other questions here, John. What about your other projects? I believe you have a gold exploration project as well, or something. So with ramping up exploration activities in Nevada in the gold sector right now, where you have a lot of work going on there right now, wouldn't it make sense to maybe sell it, do something else with the money? I don't know. I'm just spitballing.
We're open to selling it. It's, to be crystal clear, it's never been our priority. Our priority is uranium mining. So the gold project that we chased in Nevada, we chased it because we had some historic data that we had acquired, and our geologist ran across it and said, hey, some really good numbers here. Back in the 70s, when it was initially explored, the numbers weren't so shiny back in those days, with the gold prices being what they were, but today they are. So we've done a little bit of work. Our expenditure has been very, very minimal, and it's going to continue to be very, very minimal. We may do a little more exploration work out there, but if someone came along and said, hey, we'd like to make an acquisition, we'd be interested in doing that. It's not our primary objective. It's not our mandate from our shareholders, maybe is another way to look at it, but it was too good of an opportunity to pass up, especially with the minimal expenditure that we put into it.
I was just wondering if, maybe if you could sell it, raise more cash instead of issuing new shares, that'd be interesting. So, yeah, John, well, what I'm hearing so far in this interview is that you've got clear and good plans for the future. You seem like you are a real company, not without issues and challenges. We all have them. But you also sound like you have the experienced team that will work through them, hopefully, of course. But if I may introduce a little criticism as to your previous point, you're not as active on the marketing side. Like, for example, I go and check out the Twitter profile of all companies that I'm about to talk to, and your last post on Twitter was on the 4th of July. After that you had that one interview. It was a rather promotion interview, which is fine that you did. But so do you have any plans for ramping up the efforts to tell the story? Because it sounds like a good story to me. That's why I'm in it. But did you have any plans of ramping up marketing activities?
No, Antonio, I think that's a fair criticism. I think we probably could do a better job with our marketing. It's certainly something that we've looked at very hard. So stay tuned. We'll look at it some more. We may do more marketing, but if we do more marketing, we're going to be careful how we do the marketing. I think we're very straightforward and honest in our marketing. We don't try to oversell the blue sky. We try to market with a great deal of integrity. And I'm not saying that our competitors don't. Some do, some don't. There's a kind of a mixed bag there, in my humble opinion. But from your energy, it's always going to be pretty down to earth, pretty realistic marketing. And we can do that because we've got a great story to tell. We don't have to push blue sky. We can push reality.
Nice. Well, that's a marketing piece right there. We don't have to push blue sky, push reality. That's something that you can use as a slogan. John, I'm about to almost let you go here. One last section of the barbecue is focused more specifically on you. And the first question that I ask in that portion is whether you personally invest in public companies yourself. Do you have an investment portfolio?
Yeah, you bet. So no, in my personal life, I probably am not that unique. I'm after the value shares right now, especially at this stage in my life. So I'm looking for the dividends. I like silver. I think silver has been beat down for too long. So I've got a little bit of money in silver, but otherwise I'm looking for some good, solid mining companies. I've got some shares in BHP and Rio Tinto. I like those two guys. A great dividend that they're paying right now. But that's where I'm at. It's value. And I'm after the dividend to be able to see through inflation to help out with that. So hopefully that's responsive, but I'm conservative by nature. I don't do too much speculation.
Let's take it more in the hypothetical realm there. I call this the gun to your head scenario question. If you had to sell every company that you have in your portfolio right now, and you had to buy shares of 3 uranium companies, just diversify your portfolio between 3 uranium companies, which companies would you buy and why?
So obviously I like my own. I've got a lot of shares in your energy. But for the sake of argument, let's say I can't put all my eggs into one basket. So sticking with my thesis on value and a bit of a dividend, Cameco would be on that list. Energy Fuels would be on that list. And maybe NextGen would be on that list. Okay,
good. Thank you for being so direct. It is interesting that you mentioned your own company because you do have some shares, but you haven't been in the open market a lot buying your own company. And actually you had a rather large sale last year around the March time, I believe. So how come you're not, like, the share price has come down really low during this correction, in my opinion.
Yeah.
How come you're not buying that dip?
Hey, I'm glad you asked that, Antonio. That's something that I complained to my wife about a bit. Um, I'm conservative, and I've got a lot invested in this company already. If you look at it from a personal stance, I've got my family here in Wyoming. It's where we want to be, but it's still on a personal level. It's a lot of investment for me to have the job. I already have a lot of shares in the company. But let me talk about selling shares. A lot of people don't recognize that when executives sell shares, it's part of their compensation. And if they don't sell those shares, they lose them. So any executive, whether it be our company or any publicly traded company, that just lets shares go and they don't enjoy that compensation, that would be nuts. So often when an executive, not just myself, but an executive will sell shares, people will say, oh, the world's falling apart. You need to sell the company because the insiders are selling. Nothing could be further from the truth. Very often the executives are selling shares because it's either sell it or lose it. And they want that compensation as part of the compensation package. And they're going to realize that for their family. They're not going to just let that expire and not realize it. So I think there's a lack of sophistication sometimes on the blogs of people commenting on those things. So, I mean, there are many other facets to that could be discussed. But yeah, when I sell shares, it's not because I think your energy is going in the tank. It's because I'm going to realize that for my family. And someday I would like to retire. I'm a long ways from that, but I need to grow my nest egg, and that's how you do it.
Yeah. Well, you better prepare another, John Cash by the time you have to retire, just like Jeff did. As an industry insider, I guess, though, John, for many years now, I'm curious as to how you would pick the companies to invest in. Like,
sure.
I know the answer, but I'm still going to ask the question. Do you use a ratio like the EV to pounds in the ground ratio, or maybe use a different ratio? What do you use to choose those companies?
So if you're explicitly asking about uranium mining companies, I mean, obviously Cameco's in production. I like that. That's value. They've proved that they can produce. That's why in that scenario, I would select them as one. Next Gen, they've got some good quality pounds in the ground. I think in the long term, they're going to be a good producer. In Energy Fuels, they're a good story in the U.S. I think us and Energy Fuels are, in a lot of respects, very comparable to each other. Good quality pounds in the ground. We've demonstrated that we can produce. The reason why I don't select others, and I won't name any names, is because they simply haven't proven that they can produce.
Yeah.
That doesn't mean they can't produce. It simply means they haven't proven that they can produce. Some years ago, back in 2007, when the price got so high, there was something like 500 uranium mining companies that were started globally. Only a very small fraction of those, I want to say around half a dozen or so, actually got into production. So it's those companies that I would be interested in making investment in, because they've shown that they've got a quality management that can get projects into production and quality properties as well. So it's a really small universe of companies that have been able to make that demonstration. Obviously, we're part of that small universe, and the other two of the other companies I've listed are a part of that universe. So looking for that value, looking for that demonstration of quality of projects, quality of management.
So not necessarily just EV 2 pounds in the ground.
No, not necessarily. Not necessarily. Looking more broadly, if you look outside of our space, when I do investment, I'll look at those things. Those are important. I like to look at the shorts too. Maybe I'm a bit unique there. Those people that are out shorting stock, I think they're probably a little more sophisticated than the average investor. So I always like to look at the short position. I think that can be very telling on the short to midterm of where a company stock is going to go. I hate to bet against those hedge funds. They're pretty smart guys. They spend 40 hours a week investigating companies before they invest, and maybe I spend a half an hour. So I like to look at the short position and see where it's headed.
How do you look at jurisdictional risk then? Because you're pretty much mentioning the Athabasca Basin in your own country, so it makes sense. But I've spoken to some of your North American peers And obviously, CEOs of big companies within the Athabasca Basin, they would talk their own book.
Sure.
But some
Yeah.
of them actively tell me to stay away from Africa or Argentina, countries like that. How do you look at those places that offer potentially more upside, but definitely higher risks?
Yeah. So number one, if it's not safe for my employees to work there, it's off the table. I don't care the quality of the assets there. If it's not safe, we're not going. So that's number one. Number two, look at their reputation with mining. Have they been nationalizing mine assets? If that's the case, we're not interested. Number three, do they have an established long-term regulatory regime for permitting and regulating mines? That's important. We would strongly prefer that they have that. You've got to have some line of sight or some understanding of what you need to do to go into that country, permit the asset, and run it. And if you don't have that, it just adds tremendous risk. Social license as well is really important. That social license is not country specific necessarily. There are even parts of the US where the population, for a variety of reasons, is simply anti-mining or anti-uranium mining more specifically. And those jurisdictions we're going to tend to shy away from, even if there's a quality asset there. If the people don't want us there, and it makes it very difficult, and probably you're not going to move into that jurisdiction. So hopefully that's responsive to your question, Antonio.
It is, and I agree. John, it's time to turn off the barbecue and let you go.
All
So
right.
you've given me a lot of information. Thank you for investing your time in me. And is there something that you came here hoping to talk about, but I failed to bring up?
No, I think we've pretty well covered it. I've said it a number of times, but Your Energy, we're a value company. Got a contract in place, looking to get more contracts, looking for investors to join the story and to learn more about us. And I'm very easy to reach. I can, take a look at our website. My phone number and email are there. Reach out to me. Glad to talk to any existing investors or anybody that wants to jump in and talk more about our story.
John, thank you for being here, sir.
All right. Thanks, Antonio. Appreciate the time.